you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset.
There is a possibility on the other side of this that inflation could actually be quite low.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and today we're going to talk about what one of the top investors is saying right now and why he believes he's about to witness the greatest real estate correction or crash of his lifetime. But before I really get into that, guys, I really want us to try to respect just how out of whack the prices of homes are. Now, in order to do that, I'm going to talk about the PE ratio and the asset bubble and things like that. And then I'm going to tell you guys and remind you guys where we came from in the GFC, because here's the thing, you guys, understand that what I'm about to show you exceeds, as far as the bubble, exceeds the great financial crisis. And remember what was going on in the great financial crisis. We had all kinds of exotic loans. People are saying right now, we're going to get a 100-year loan. You guys, during the great financial crisis, we had loans back then that were 40-year loans, that were interest-only loans, and that were negatively amortized loans. And on top of that, the standards were so low. We had loans that had, and it's not called Ninja. If you call it Ninja, that means you don't know how loan guidelines worked back then. Ninja is just an acronym that's used to help people understand what happened. The correct term was NINA, which stands for no income and no assets, and CISA, which is stated income, stated assets. And also, you guys, don't forget, back then we had something called negatively amortized loans. That basically means that you will never pay off the balance of your mortgage. In fact, the balance will actually go up because remember, it's negatively amortized. And despite all of that exotic financing, the bubble that we have right now with all of these strong mortgages is even bigger. So again, think about what I'm saying. Even with all those exotic loans, the bubble was smaller. Do me a favor, understand I'm not a financial advisor, even though my bio is as someone that is deep in this research. My bio is someone that wants to purchase my primary residence. My bio is someone that is using the data to find the deal. I'm increasing my purchasing power, and I hope you are too. And if you guys can, please like this video, subscribe if you haven't already, shoot me a comment below, and please, you guys, learn and better yourselves. Looking at first the national payment to income ratio. Y'all see that right now we're sitting at a whopping 40.5%. And if we read the disclaimer here on the bottom, this is going to say this is only including right here, you guys, monthly principal and interest at a 20% down payment. So this is not including taxes. This is not including insurance. This is not including HOA. And this is based on your gross income. So the reality is we are probably closer to a 50% national payment to income ratio. And if you see during the great financial crisis, even with all of those exotic loans, it was still more affordable, sitting at 34%. When we move on to the payment to income ratio, and again, price is so important. Used car salesmen only want you to pay attention to payment, because if all you're doing is paying attention to payment, then you don't care about the price. Overall, price is more important than payment. And if you don't believe me, ask investors, ask people that are purchasing with all cash. Obviously, the price is much more important. But you can see here the median home price to median household income. Basically, what this is saying, you guys, is we're sitting at over 7 right now. During the great financial crisis, you guys, we only reached about 6.9. It's actually kind of hard to see that in this graph. I'm not sure what's going on with Black Knight. But again, the bubble right now from just a price standpoint is bigger, and it was created in half the time. The foundation that we're sitting on right now, you guys, is an absolute house of cards. Now, obviously, what we've noticed is there's still juice to be squeezed. There's still excess savings. And as such, unfortunately, the bubble continues to get bigger. Comments that I get constantly is we're not in the same foreclosure situation. And that is 100% true, but that doesn't mean that the trajectory of foreclosures is not skyrocketing. Finally, now that the foreclosure bans have been listed, we can see right now, month over month, we have a 30.4% increase in foreclosure starts. And that's just till October. We don't even have November and December stats out yet. And remember, you guys, the moratoriums ended at the end of November. So I suspect we're going to see a lot more of the foreclosures skyrocket once we get the statistics for December, and unfortunately, we won't get that till January. Here's one more thing I like to look at to show people how much prices matter. When we show this Case-Shiller Home Price Index over CPI, and we go back 100 years, we really start to see basically the gap. And it's kind of a wage gap start to happen in the 70s and 80s. And really it spiraled out of control here during the great financial crisis. Do y'all see that? And then it went down and crashed, obviously. And then now look at this bubble. So it's really easy to see, again, that the size of the bubble right now is really way bigger than last time and done in about half the time. What I'm saying right now is the housing market is incredibly toxic. And unless you're purchasing with great fundamentals, most people, in my opinion, as someone that has helped 1,000 or more consumers in my career, we should probably time out, understand first how it works. How do we find the wedge? How do we find the cash flow? How do we use the data to find the deal? And I'll show you guys that at the end of this video. I'll show you what it's going to look like from a data standpoint once we get into more crashing statistics. But first, let's listen to a video from Grant Cardone that's going to go into why he believes we're going to see the biggest correction of his lifetime.
And sellers alike feeling a massive struggle to close deals or make money. And if you need yet another sign of turmoil, 45% of U.S. real estate agents are struggling to pay rent on their offices. Here to react is private equity fund manager and real estate investor.
Not to mention real estate agents, really anyone in the real estate market, we already feel the recession. In fact, we've been feeling it for the last year. In fact, it feels like a depression. Again, real estate agents already feel this, which is so shocking to me that most of the time they're the loudest cheerleaders, yet they are the first to witness it. Big shame, big L for the entire industry as far as helping consumers be cautious.
Grant Cardone, welcome, Grant. So tell me, why are real estate owners and agents not able to pay the rent? What is going on?
Well, because, Rachel, the Fed single-handedly has killed the housing market. The Fed will make more renters in this country in the next 2 years than it has in the last 50, because mortgage applications are at all-time lows. Mortgages are double what rent is today. And it doesn't surprise me that real estate agents are feeling the brunt of this. Back in June of 22, Jerome Powell said that the middle class, everyday people would disproportionately feel the pain of higher interest rates in his attempt to control inflation. He has not controlled inflation. He has failed miserably. What he has actually done is create it and, in the meantime, stop the housing industry.
What would you recommend he do?
Well, what he should do is get out of the way. There's no time in history in my lifetime that the Fed actually controlled interest rates. Supply and demand is what controls interest rates. As long as people are spending their money, that means they want that product or service. At what point it gets to a price where I no longer find it valuable, I will no longer continue to purchase that. And people want homes. People want to live in a single family home. I don't personally think it's a great investment. I've said that many times. I've gotten ragged out on it, but
you heard it from Grant Cardone's mouth specifically and directly. He just said that investing in an SFR or SFH, which is single family resident or single family home, is a bad idea, probably because of all of the data that we just went over, as far as it's a double whammy with both, not only just price is unbelievably out of whack, but so is the payment to income ratio. I mean, the Federal Reserve has really taken us for a loop through this whole virus situation. And it's so crazy to me, again, how out of whack things really got when they didn't need to get this way. That's what I'm trying to tell people. It didn't need to get this way. So again, comment below. Let me know if you agree with this man. Let me know if you think that an SFR is a bad investment. Comment below. Let me know your thoughts.
He should step aside, get out of the way, let the market do its thing. Interest rates will have to come down in order for pricing to come down.
Right.
This is actually a contradiction to what most people think. But when interest rates come down, mortgage applications will go up. People will start selling their home.
So the last couple of videos that I made, I touched on this topic, which is basically the golden handcuffs are going to be shattered in 2024 and into 2025, and that by interest rates coming down, we will have some buying demand come back, but we will also have all of those sideline sellers, which is probably anywhere from 1.5 million to 2 million existing home sellers that would sell their property if they could afford to. And we understand that homeowners that purchased prior to 2022 are suffering greatly because we see it in the cash out refinance numbers. So everyone right now is in distress, but I want you guys to do me a favor, comment below and let me know your thoughts on what happens when the interest rates go down. He's thinking that when interest rates go down, prices will also go down.
Well, the World Economic Forum had this famous commercial where they talked about the Great Reset, and they said, you will own nothing and you will be happy. And you're seeing that happening. You're saying that we are becoming a renter nation. I say it's by design. Explain what you mean by it.
The rents in this country, the average rent, as much as people complain about them, we have 12,000 units. The average rent's about $1,800. And as much as they complain about it, the mortgage on a similar home in that same neighborhood would be double that, plus insurance, and plus a PMI, which is mortgage insurance on the mortgage itself. So it's unaffordable for people to own a home today. And that means you will rent, you will literally own nothing and be happy about it. Now, the apartment complexes that are being built today provide such crazy great amenities that it is actually for new generations of people. It's actually an alternative that's not economic, but actually desirable for them to actually live someplace for 10 or 24 months at a time rather than hunker down for 30 years.
Yeah. Well, these hedge funds and private equity firms are buying up property and then, making them into rentals. And we're seeing, as you said, less and less people owning their home, which always was the American dream.
And this is...
Go ahead. Last thought.
Yeah, I just want to say that we're entering the greatest real estate correction in my lifetime. It will not include single family homes, but it will include office, which we're already seeing that damage, and we're going to see it across the entire apartment complex. It's going to be a great opportunity for individuals, regular everyday people, to actually grab trophy real estate from institutions. This has never happened in this country. It's going to be at epic levels.
All right.
So what he's saying is there's not going to be a crash or correction with SFRs, right? But the crash and the opportunity is going to be for everyday people like you and I to purchase commercial property, 5 units or more. Comment below and let me know what you guys think about that. Now, one of the reasons he's saying that is there's an absolute meltdown. Literally, there's an absolute meltdown going on with commercial real estate in the form of vacancies, rents actually softening, values plummeting, and also, you guys, hyper supply. We have a hyper supply phenomena, really phenomena, shocking amount of new construction going on that is just adding to the problem when it comes to the rental market. Let me show you now. Going back all the way to the early 1970s, and this is new privately owned housing units that are under construction. And I just got back from traveling to 11 different metro areas. Some metro areas, especially Denver, is exploding with brand new, huge, hundreds, if not thousands of apartment units. In the 1970s, early 1970s, they had 901,000 units being built. But right now, you guys, look at this is just literally exploded, getting to about 1 million. Right now, we're sitting at 987,000 units that will probably be coming to the market within the next year and a half. So there's going to be outstanding turbulence, ridiculous turbulence in the rental market from now till about probably into 2025. He's also explaining that it's a lot more expensive to own right now than it is to rent. When it's cheaper to own versus rent, it's almost a slam dunk, okay? Obviously, price is still important. You want to make sure to have the right expectations. But here's the thing, you guys, according to this article from CBS, it now costs 52% more. 52%. And honestly, it's more than that in some of the areas that I want to buy. It's double. It's 100%. But on average, it costs 52% more to buy a home compared with renting an apartment. That is so crazy. And to give you guys an idea, by comparison, at the peak of the housing bubble in 2006, it was only 33% more expensive to buy versus rent. So again, what I'm trying to explain right now is not 2008. It's not the GFC. It's not the 80s. It's not the 1920s. It's not the 1940s. What we have right now is way worse in some areas. And in other areas like foreclosures, it's a bit better. Overall, everything is completely out of whack. We see Canada suffering, China, Australia. We see the world right now suffering as far as the housing market. To really try to hammer this down, you guys, the federal funds rate. This is the chart for the federal funds rate. Every time that we had a yield curve inversion, so while we were still inverted, okay? So again, while we were still inverted, anytime they started cutting interest rates, it led to recession. Look at going back to the 1950s, recession. Look at right here, they cut rates, recession. Right here, they cut rates, recession. They cut rates here, but we got out of uninversion. We reverted right here, okay? They cut right here, recession. Right here, recession, recession, recession. They cut here, recession, cut here, recession, cut here, recession, cut here, recession. What does all of that mean? It means, well, to the layman and to me, unemployment. Now, I don't want people to get unemployed. That's why I'm trying to warn people to buckle down right now, do a side hustle, and try to make as much money as possible in the front end of recession. So that way, when the recession does come here, you're better prepared to get through it, and potentially you can become rich. You guys, that's what I've been talking about. We can become richer than we've ever been by being patient right now, understanding how to find a great deal, and then executing and getting that great deal once you find it. So let me explain, using data, not emotion, what a housing market crash from a data standpoint is going to look like. I'm going to do that by showing you MLS data. Now, we've been watching the area of Kingwood. Okay, so here's Kingwood right here. You guys should know I've been looking for about $120 a square foot or lower. I'm looking at all of the active listings, and let me show you guys, now I'm going to put a range of square footage because that's how we've been studying the housing market. There's a lot more involved in that, but that's how we've been starting. So I want to find houses between $100 and $105 a square foot. Okay, you see that right there? So there's my range. Now, as you see here, let's pull up the map and see how many properties we can find right now at that $100 to $105 a square foot. Look at this, guys. One property in the area that I was looking at, okay? So one property. So that's what things look like right now. And what this means is right now, I can find homes that are priced in the 2020 and 2021 price point. But how many can I find, you guys? Look at one in this whole area of Kingwood. Now, what a crash is going to look like, it's going to look like this, where there's multiple properties in the price per square footage that you want. And really, from a data aspect, you guys, that's what a crash or correction is going to look like. In other words, understand that both price and payment is important, and understand that if you are going to buy real estate, it's a really, really good idea. Don't let other people do the thinking for you. Don't get trapped in some echo chamber. Listen to both sides of the coin. And in my opinion, we should be looking for real estate that has both wedge or equity in the property and cash flow. If we have to sell, we want to be able to convert to a rental and cash flow and not be trapped in our house. And overall, you guys, having the right expectations. And it's very sad to me that we cannot lean on professionals in our industry to remain cautious. If people want to buy, so be it. Maybe some people's PE ratio is 1. Maybe their payment to income ratio is 10%. Maybe for them, it is cheaper to own versus rent, and they have the realistic expectations. And in that situation, fine, purchase. But again, understand, you probably need to make it through some really, really hard times that we're facing. And unless you're well positioned, in my opinion, guys, I just don't think we should be doing that right now and risking it. Now, I myself, I'm not a rich person. I have to make the right decision. I cannot afford to make a bad decision. And so if I have to rent another year, I don't care, because what I'm doing right now is making sure my financial situation is safe. Now, again, if I was really rich, then maybe I wouldn't care, but I'm not really rich. I'm like the other 90% of Americans right now that are struggling. Now, anyways, guys, I really hope you guys found some value. I really hope you understood and appreciated the perspective. I'm not a fortune teller. You have to do your own thinking and follow the data. Now, other than that, guys, if you're out there investing in real estate, you know I wish you luck, and I hope you win.